Welcome to This Week in Money. I'm Phil Mackesy. Today, Robert Campbell on U.S. real estate. Danielle Park covers Wall Street. And David Smith wraps up the week in metals. We begin with Robert Campbell right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Robert Campbell wrote Timing the Real Estate Market. He publishes the Campbell Real Estate Timing Letter. Hey, the new edition is out. You can find him online at realestatetiming.com. Bob, welcome back to This Week in Money.
Thank you.
You are in sunny California today, and we've got some housing news from the U.S. Of course, a couple of self-serving PR announcements here. I want to get your take on. The National Association of Realtors saying pending home sales reached a 2-year high. That's good news for them. And the National Association of Home Builders, these guys are saying, guess what? The housing market is showing signs of strengthening in the U.S. What's the real story? What are you seeing?
Well, the real story is that people have been calling for a housing market bottom for what? At least the last 2 years, maybe the last 3 years. And the fact of the matter is, if you look at some of these home price indexes that are put out by Case-Shiller, by what are some of the other ones that, I'm sorry, it slips my mind. But the fact of the matter is the data shows that in all categories except the low end of the market, housing prices are still falling, Phil.
Mm-hmm. I saw something from the LA Times this morning saying that the low-end prices, low-end activity is picking up, but of course the high-end activity is basically doing nothing. Let's talk about California for a sec. You are based in California. You see a lot of interesting things going on in there. Give us a quick snapshot of the California real estate market.
Well, the California real estate market, we've held up in the last year. I follow three major cities, track them closely: San Francisco, Los Angeles, and San Diego. And last year, the average price house, the median price house, is down anywhere between 3 and 7%. Okay. In fact, I think it's down 8% in the Los Angeles area. So in the last year, we're still seeing a continuation of the downtrend.
When you say average price, what's the average LA house worth?
Oh my gosh, I don't follow. You know what? I look more at the data than the absolute numbers.
Okay.
Because if a house is worth $390, the average price was $390 last year, and it's worth $370 this year. All I care about is the trends, Phil,
sure.
And the price is down. But when you look at the entire state, I think the state of California, for the state as a whole, I mean, you're including some high-priced areas and some low-priced areas, like in the central part of the state. But I believe the average price right now is around median price is $280,000.
Now, everybody wants to live in California because the weather is so nice, but the economy is in bad shape down there.
Very bad shape. And from a financial standpoint, our budget deficit, our state budget deficit is the worst in the United States. Wow. And I just read a statistic that last year that California lost 120,000 jobs. And by the way, the state of Texas picked up 130,000 jobs. So they're going. The businesses are going to the more business friendly states like Texas, that as opposed to California. And that somebody did a poll recently, and they rated all the states in the United States as far as being most attractive to business. California, I believe, ranked 48 out of 50 states.
Let's talk about the national picture, and the Case-Shiller shows us what's going on. What's happening nationally with real estate?
Well, the latest statistics, home price statistics, were for December, and that we hit a new post-bubble low, Phil. So even Case-Shiller's showing that we're going down.
Okay, wow. Of course, one story getting our attention these days is foreclosures. Here's an interesting stat. 25% of homes sold in the most recent quarter are foreclosures. That's a very large part of the market, and it's getting worse.
Yeah, it is getting worse. That what I read, I mean, I haven't seen anything where it's getting significantly worse. But the fact of the matter is that we still have a 7 to 8 million home overhang of properties that are going to be hitting the market at some time in the future as distressed sales.
Yeah.
They're going back to the banks, and the banks are going to put them out as REOs and or short sales. And that doesn't include, Phil, the number of people that are underwater on their homes.
Mm-hmm.
So essentially right now, when you look at the number of people that are in default on their mortgages or properties that are owned by banks or that are significantly underwater on their homes, there is something like there's 10 million homes that fit in that category.
Wow.
So that is quite an overhang, and that's going to continue to weigh on housing prices and keep housing prices, pressured to the downside. And that's especially so. I mean, I don't even need to pile on with even more bad news, but by my historically reliable recession indicators keep flashing that a recession is a good bet to make. So in other words, even if we don't see a recession, let's say that we slow down to 1% growth, as opposed to being into negative growth. Does it really matter that much? Considering the high levels of debt that the government and the private sector is carrying, I don't think so. I think we're in for a long haul of subpar growth with frequent recessions along the way. So I'm not really optimistic about housing prices making any kind of significant turn to the upside.
So obviously the National Association of Realtors, the house builder guys, I mean, these guys are talking their book when they're telling us the market is strengthening. Yeah.
They're paid shills, Tom. Yes. You and I both know that, right?
Yeah.
Do you think if they wouldn't say something optimistic that they would have a job? No.
I don't think so.
No. Is that a source of objective information? No, not at all. It's really, but the average guy out there that, they grab the headline news and, the headline news says one thing when you really study the facts, that, it can be something completely different.
Bob, you touched earlier on recession risk and oil. What do you think an increase in oil prices, an oil shock, if you will, is going to do to the housing market?
Oh, absolutely. You know what? That will do nothing good and could do a lot bad because, even though high oil prices may not by themselves be the cause of an economic downturn or recession, fact of the matter is that 10 out of the last 11 recessions in the United States were preceded by a spike in oil prices.
Interesting.
And as you know right now, oil prices are over, in U.S. dollars, over $100 a barrel, and gasoline prices, I think they're close to the old levels they were back when oil was at 150, when oil went to 150 a barrel.
Pretty close to
$4.
We're
definitely in the danger zone in that area by itself.
We're talking to Robert Campbell from the Real Estate Timing Newsletter, and we should touch for our Canadian friends here on what's happening in Canada. Even though you do not specialize in Canadian real estate, I want you to get your opinion on a couple of things here. TD Bank Chief Economist Craig Alexander saying today that Canada's real estate market is unsustainable. He figures, and I don't have the facts to back this up, he figures real estate's overvalued, Bob, by 10 to 15%. What's your take on Canadian real estate? What do you see from where you are?
That I don't study the same metrics, historic metrics that I do for the United States, of course, Phil. But my gut tells me that he's right on. Based on what I know, I've read a little, but I haven't studied it.
Okay.
But I bet, because I know that you guys haven't had a downturn in housing prices yet. What major economy and you've had quite a rise in housing prices. I think that you guys are getting set up for a very nasty downturn.
What kind of things do you think will drive that downturn, Bob? Any idea?
Well, I think what's going to drive the downturn is the global economy.
Okay.
Europe's in recession. The United States is in recession or in slow growth or going into recession. And the Canadian economy, you're highly dependent on the rest of the world.
And especially the U.S.
Absolutely.
Yeah.
The good thing, what you have going for you is, I don't know what percent of your economy depends on oil, but that seems to be doing rather well.
Yeah, a big chunk of it does.
Well, that's good.
Yeah.
You've got a valuable resource.
Let's
so,
also...
that's one of the things that I don't feel qualified to really have strong opinions on the Canadian market. But I do kind of sense that you guys are kind of levitating at a level that there's more risk to the downside than there is opportunity to the upside.
You've already seen this happen in the U.S. real estate market. You see us following the same kind of trajectory? Is it possible to avoid that?
You could very well do that.
Yeah.
You could very well do that, based on what kind of, how far prices have risen in relationship to incomes, in relation to the debt levels that you tell me that Canadians are carrying, which are like up at 150% or something above normal. Mm-hmm. Those are dangerous metrics, Phil, and people would be wise to carefully study that and start tracking these trends that, as far as, exiting the market.
I guess one of the things people are cheerful about up here is that interest rates, we are following the lead of the Fed, of course, will stay near zero until late 2014. And that may be a good thing, but that's also a bad thing, right?
Well, it is a bad thing. And you know what? And interest rates, low interest rates by themselves are not the most important metric to follow, Phil, because the National Association of Home Builders here in the United States is telling us that housing affordability has never been higher before. 75, by their metrics, 75%, based on incomes of all households can afford the median price home. Mm-hmm. Oh, wow, that sounds wonderful, doesn't it? What they don't tell you is in the last, 10, 15, 20 years that household debt to income ratios have doubled. So in other words, when you start trying to qualify for a mortgage, which is very difficult to do nowadays, and you start adding on your credit card loans, your student college loans, your car loans, and every other kind of loan that you have, that's ruining your ratios, so that there's that much money, that there's not that much money left over for housing, as the NAR wants you to believe.
Mm-hmm. We're talking to Bob Campbell from the Campbell Real Estate Timing Ladder, and for Canadians looking to invest in the U.S. Let's talk briefly about opportunities in the States for Canadian investors.
Okay. Where I think if I was a Canadian looking to purchase a second home or a primary home for that matter, in the United States, where I think the biggest value plays are right now, based on low housing prices and levels of income, it would be in two markets. One would be Phoenix, and one would be Las Vegas. Okay. Both of which have warm climates that I know that you Canadians enjoy during the wintertime.
Phoenix, 28 Celsius today, 82 Fahrenheit. Beautiful day down there.
Well, I guess that maybe dogs will start sleeping with cats in March too.
We're talking to Bob Campbell here on This Week in Money. And Bob, tell us how we can subscribe to the Campbell Real Estate Timing.
Well, you can go to realestatetiming.com, which is my website, and you can look at the links. You can read a couple sample issues of my timing letter. You can buy my book, Timing the Real Estate Market, if you wish, or if you can get it free if you subscribe to a 1 year subscription to my timing letter.
All right, that sounds great. Robert Campbell wrote Timing the Real Estate Market. He publishes the Campbell Real Estate Timing Letter, and he's online at realestatetiming.com. Bob, as always, a pleasure. Thank you for talking to us.
You're welcome. Thank you, too.
Coming up, Danielle Park on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She's author of the best-selling book, Juggling Dynamite. You can find her blog at jugglingdynamite.com. Danielle, it's always good to have you back on This Week in Money.
My pleasure, Phil.
Got a couple of milestones for Apple this week. The third generation iPad going on sale this week, and a big move here. The share price hit $600 this morning.
Yes, surpassing the market cap of everything else in its wake. And this is a wonderful story that I think has gone into the bazaar now. I think in a world where there's very few strong, innovative companies, you take that that basis of a legitimate story and stability in the company and lots of cash, great business model, great innovation, and you sort of balloon it right out. So now I noticed, for example, that something like 250 hedge fund managers all have substantial positions in Apple. I think this is like a question of, not a lot has been working, and so everyone's sort of desperately running towards the one thing that seems to be the consensus view. But I tell you one thing, Phil, something we've learned over the years is that anytime you get a consensus in agreement about something going in only one direction, you find that that's exactly when it turns on them.
It's been a pretty good week for stocks overall, the bull market entering its fourth year. Now, who are these analysts and experts who are saying the market's being driven by fundamentals and that stocks are heading higher?
Well, you really do have to break things down into a lot of constituent elements there, because if you look, for example, at the TSX, it actually is back at the level, it's something like 10% below where it was this time last year. So it's not fair to say that everything's making new highs. The S&P certainly has made a new high, and you have some leaders there, for example, in the banking sector the last few months, which goes back to, how much assistance the banking sector's received, the unprecedented intervention. They've been backed by the Federal Reserves all over the world, and they were doubling down on their proprietary trading, and it's really evolved into this risk-on trader mentality at all the investment banks. So now you have, for example, the news this week, Phil, where J.P. Morgan jumps ahead of the queue and leaks a report to the market saying, hey, we passed the stress test. This whole new round of rigged stress tests, which are all designed for the majority of the banks to pass them, right, so that it restores confidence. So you've seen some momentum to the upside, pushing the overall index in the U.S., for example, higher this week. But I think that the mixed currents there are quite remarkable. At the same time, you have things like the China slowdown story really starting to take some traction. You have things like the Euro story continuing to bubble behind the scenes, right? So you have things like Greek bonds that remember last week, Phil, all the hullabaloo about this, who was taking up this new issue of bonds and the big haircut. Well, the next day those bonds traded for 18 cents on the dollar. So it's absolutely not fixed anything. It's absolute nonsense. And so you get this sort of Laurel and Hardy show each day, and people call that sort of intelligent assessment. But really, you've got a bunch of other governments now, like Ireland, who has stated outright, we now wish to go back and renegotiate. We want a haircut on our bonds too, which makes perfect sense. And you've got Spain missing their budget restraint targets by a huge margin, and basically saying, sorry, too bad, we're not even going to try and cut more right now, as their housing market has finally started to fall, Phil. This is an interesting story we've been watching. The Spanish housing market continued on up after many other parts of the world had already began to decline, and now we're seeing that in many parts of the country, property values are dropping anywhere from 20 to 50%. So there's a lot of, headline stories like, hey, the banks get to pay dividends, which, by the way, we don't want them to do because they still don't have sufficient capital, and they're still taking big risks, and they've still got the taxpayer on the hook if they blow up at this point. So we really don't want them depleting their capital, but you get a story like that moving the market, and you get Apple at euphoric highs and everything else kind of quietly crumbling in the background.
Another index we watch out of the corner of one eye, the VIX, hitting its lowest level since 2007 this week as well, Danielle.
There is that's the quintessential poster child for the complacency in one part of the population or segment in these markets, and the reality-based assessments by some of us. For example, the VIX. So you see that it really just plummeted more than 30% in the last couple of weeks, as this whole belief that, number one, Europe had patched itself, and number two, that the banks in the U.S. had passed this stress test. So you had a lot of anticipation this week about whether the Fed was going to tip its hat. And Bill Gross tweeted, this is the world we're in. Bill Gross tweets this week, hey, expect them to say something about more QE at the April meeting. And you see stocks surge like 1.3% in a matter of the last hour. So you get that kind of euphoria, and the VIX crumbles because everyone says, wow, if they're going to intervene again, they're going to prop markets up more, then there won't be any downside risk for a while here. But the sad reality of that is, Phil, that when the VIX is low, that's actually the greatest risk because that dictates complacency in widespread use. So that's an example of the last time the VIX was at current levels, below 16, was just before the mess hit in 2007. So mid-2007, you had a VIX fall to 16. Now we're back there again, which is not a very calming idea for anyone that knows how to read this stuff.
Danielle Park is our guest on This Week in Money, and the Fed, of course, got together this week. What was the big deal? They basically announced nothing, saying they're going to keep rates low at least through late 2014.
Yeah, so this goes back to something I think we were talking about a few weeks ago, Phil, which is, again, I like to look at what are the prima facie main consensus view coming into 2012. Well, I think they are as follows. There's a widespread belief that central bankers will print, and not slow pumping liquidity into the global banking system. That's why I think you see this plummet in the VIX indicator, right? A belief that central bankers will be able to somehow hold off the gravity or the reality of stock prices, make them stay where they are rather than revert more to their long-term average. And then also there's a belief that they will continue to print. So you had things like gold, right, going through the roof in the last number of years, and certainly having a good rally again in the last few months. And then all of a sudden they come out and say, well, the economy might be doing better, so we don't know if we can basically justify more QE, do more intervention. And so what if, coming into the 12, what if that belief that there's an endless amount of printing is not the case? What if the political pressure, because all these governments are switching in the next 12 months, all over the world you're having elections everywhere and people getting thrown out. Sarkozy looks like he's not going to get back in. You've got Chinese big political turnover there. You've got the U.S. elections. What if they don't actually intervene much in 2012? That would be a big shock to this market that's so complacent and addicted, really, to free money. So I think that might be a major theme. And also, as I say, another one of the consensus views has been that China will grow no matter what, because they're centrally planned and they will pump money, and they've got this $3 trillion, this $3 trillion of reserves, and all that. But actually, they're saying now, listen, we've got a huge problem. We have a huge overbuild and overdependency on the property sector. We've got a massive bubble. We have to allow this thing to cool down. And so they're not stepping up either towards more stimulus at this particular time. So I think that the disappointment could be that nobody does anything big for a while here. And then you've got just the stock market, on this wild ride, suddenly trying to relate to where is growth really at. The Chinese slowdown story is likely to hit commodity-centric countries like Canada and Australia. Our currency's been overvalued again on this belief that exports to China will never slow down. Well, they are. And we're seeing it already, Phil. It's not a future story. It's right now. Cement and steel and a lot of the components that the Chinese have been voraciously gobbling up to overbuild their infrastructure the last number of years are now plummeting in terms of they're not buying the stuff. And so I think that could be another big surprise going into 2012, that China actually has a significant slowdown, that central bankers don't continue to just print right now, with all the political pressures, and that there won't be any real backdrop to counter this slowing growth story, in which case you could see a lot more volatility come back into markets. Even bonds, Phil. Okay, so bonds in the last couple of weeks have sold off again, I think part and parcel with this belief that, coincident indicators in the economy are maybe looking a little firmer to some people, and the Fed said, listen, guys, we don't need to do more QE right now. Things seem to be tentatively improving. So you've kind of got that belief system going on. And I think that that's where you see capital coming out of bonds again, maybe, out of the safe haven idea, pulling out of gold, pulling out of bonds. But if we get into this next phase, which I believe will be a surprise to the downside on the growth story, I think that this might prove to be a buying opportunity again, certainly for bonds. Now, for gold, I'm not so sure. At this point, we're kind of in the middle. We're kind of in it hasn't broke 1550 and it hasn't broke out to a new high. So you may see that if the fear trade comes back, people repatriate money back to what they consider to be a safe haven there. However, at the same time, you'll have delevering going on. So it's a question of, will there be more buyers than sellers? And right now, it's really difficult to tell.
We're talking to Danielle Park on This Week in Money. Lots of cheery talk this week about the U.S. economy, Danielle. On the road to recovery, unemployment claims falling last week, another 15,000. But you're looking at some new information from the ECRI folks. What do they do, and what does the report tell us?
Well, they have this, 40-year track record of using these basic a composite of indicators that they're, very objective in taking measurements, as objective as humans can be, I guess, in taking measurements of the economy, which is a little bit imprecise and retrospective. But they've had a very good track record of calling downturns recessions, and they've been saying for the last, many months that there's a U.S. recession coming in 2012 based on their leading indicators. So I think one of the big things, and they explain it in the report that they released today, I put a link on the blog, is that the seasonality aspect, warm weather, warmer winter than normal, Phil, in a lot of the north this year, has really skewed some of the data, both in terms of employment and certain sectors that have done more hiring as a result earlier. And also they explain in that piece about the how the indicators responded in the 08-09 downturn, how they basically went off their normal trajectory because that recession was so deep relative to recent history. And as a result, the bounce back in some of those indicators was a little misleading. So they're saying they think that even some of the positive stuff lately is going to be corrected in retrospect down the road, and that we will see that it was really giving a false positive in terms of momentum and growth in the economy. So their chart is quite obvious. Okay. They show it, and I put it on the blog. It's just saying, guys, listen, we're not making this stuff up. I know you don't want to hear it, but here's the picture. Every time the leading indicator composite has fallen in the way that it has, we've been about to or already entered into a U.S. recession. And we know we're in recession in Japan and the Eurozone and the U.K. So really, if China's weakening, as all indicators suggest it is, where exactly do we expect this growth to come from in the next year or so?
Danielle, one of the fun stories this week, People story, Goldman Sachs exec Greg Smith quits this week in the New York Times and says Goldman is toxic.
Yeah, he found religion, Phil.
Yeah.
Good for him. I say better late than never, Listen, I spent the first few years of my career in the Southside Institution, and I would have to corroborate everything that he indicated there. It's a hell of a culture. And there's some people that would say, listen, it's capitalism, and of course they're there to sell a product and make a profit. And I agree with all that. That's wonderful. But here's the problem. In the last 15 years in particular, the banking sector has migrated from we're a product sales company to we're your trusted advisor mantra, right? So they've sold and packaged themselves as no longer, sharks you should wear shark repellent and be careful with, to don't worry, trust us, we'll lead you where you need to go, we'll help you become rich. For countries, we'll restructure your debt, we'll help you get into the EU, we'll help companies, be taken public, so we'll reconfigure all your balance sheets, we'll put a bunch of stuff off book, we'll help you figure out how to dupe the investment public, and then we'll start dealing with you and taking advantage of you as our client. Now that we've convinced you to trust us and we're the smartest guys in the room and all that, now we're also going to do back deals and stab you when you're not looking. So at some point it becomes this cesspool, and this goes back to why Paul Volcker, or the Volcker rule, or why we had Glass-Steagall in the first place, because it's very common in history that this is the trajectory that financial institutions take. They were divided, 60 years ago for exactly these reasons. They needed to be broken down into constituents. And if Goldman Sachs wants to be the shark on leverage who's trading, and taking big bets and making big bucks, fantastic, but do it on your own time. Do it on your own buck. Don't have any expectation of bailout from the taxpayer. Don't, parade yourself as this trusted advisor. Put a disclosure saying we are sharks, deal with us accordingly. And we need to go back to that.
Danielle Park is president and portfolio manager of Venable Park Investment Council. She wrote Juggling Dynamite, an insider's wisdom on money management, markets, and wealth at last. And you can find her blog at jugglingdynamite.com. Hey, thanks, Danielle.
Hey, Phil. Great.
After the break, David Smith on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
David Smith is a precious metals analyst and frequent contributor to the Morgan Report at silverinvestor.com, and he joins us from his home in Seattle, Washington. Dave, it's always good to have you back on This Week in Money.
It's really good to be back, Phil. How are you doing this week?
I'm doing great. We had a good week also for stocks. The S&P 500 over the 1,400 mark for the first time in nearly 4 years. The Dow at its highest point since December 2007. And the NASDAQ also rocking its highest level since way back in the dot-com era, November 2000.
Well, you know what they say, the reasons for certain things and price movements come out later. So everybody's pontificating about the whys and the why-nots, but price is what it is.
It sure is. Now we had a pretty good week up until just recently. The market closing around 2% higher before the University of Michigan consumer sentiment figures came out. And that kind of took a little bit of the bloom off the market. But there is still some pretty exciting stuff going on.
Well, there really is, and there's some pretty powerful stocks that are making new all-time highs or certainly multi-year highs. And there's a lot of money that's been off the sidelines. It's apparently starting to come in. And I know you know this, but for like 8 or 9 months, there's been massive withdrawals on the part of public money from their funds. And so maybe some of that money is starting to come back in. That's oftentimes a contrarian indicator.
Starting to see some of those reports in the financial press about the retail investor getting back in. And here's an interesting measurement that we always kind of look at and see what's going on. The VIX hitting its lowest level since 2007 this week.
Yeah, it's it measures the level of volatility, and again, that usually is a contrarian indicator. And it's just, it's human nature, I guess, to not want to buy something when it's going down. If you go in the grocery store, you don't want to buy something that's going up in price. But if you go in the stock market, you want to pay more, it seems like.
We do just the opposite, right?
Dichotomy.
What do you make of the mood out there with retail investors and with the market?
Well, I think it depends on where you look. For example, I've been looking at real estate recently in the Pacific Northwest, and there's a lot of softness out there still, but, the good properties are starting to find a bid under them, and people seem to have a little bit more optimism, and there's still a lot of concern and pessimism out there, but sometimes you just have to take a chance a little bit. You need to be careful, but if you wait until everybody's thinking the same way, then you're walking behind the herd, and I think sometimes it's helpful to get out a little bit in front of them, but not too far out.
We're seeing a lot of anecdotal evidence, Dave, of recovery, and of course we can be cynical that a lot of this is simply people talking their books. Do you think a recovery is a reality? You're in the middle of what's going on down there.
Well, there's a lot of talk about later this year we're going to have some really huge problems, and you just don't know. But I feel that if there is a recovery underway, and even if it's tentative, the better players are going to be the ones that you're going to see first. And for example, we talk about mining stocks a little while later. You want to watch for the best ones, the ones that start their move first, are usually the best quality ones, and they usually go the farthest. And I think it's the same with a retail establishment that's really been working to get their business honed up during the recession, or one of the better houses rather than just a also-ran type of house if they're trying to sell their property. So, it's quality that starts moving first, and usually the last movers are the lack of quality. So from that standpoint, I think that careful optimism is certainly warranted.
We're seeing a lot of optimism around the banking sector, around Europe. We've seen some pretty upbeat economic reports this week. And, of course, we can't overlook the role of the Federal Reserve in all this. The Open Market Committee meeting this week basically said we're not going to do anything different, but we're a little more optimistic about the U.S. economy than we were.
Well, one of the things that I think is really that people really need to understand, and this was brought home to me when I was listening to Frank Holmes speak in January up in Vancouver, is that I think the figure he gave was like 25% globally increase in the monetary supply across the globe. And so this type of liquidity, once it starts being utilized and spent, is going to cause things to go up. And so I'm sure that that's a kind of a factor that isn't being analyzed much lately, but it's got to be a significant factor. And you can pump liquidity into the economy, but if people are afraid to spend it, that doesn't mean anything. There's no velocity. But I think what we're going to start seeing is a recognition of more velocity going on and more money being actually put into something rather than hoarded. And so that's what I think one of the drivers, you might have called a foundational driver that's going to take things wherever it's going to go. We don't know how strong or enduring that'll be yet, but for now, the early movers are saying, let's give it a shot.
You're touching on the sentiment issue, and that's really important with what's going on, especially with the volatility, right?
It really is. People far wiser than I have talked about seasonality and technical analysis and all that. And the ones that really know their stuff and really come out in a minute say, you know what, all this says certain things, but if sentiment isn't there, sentiment can override everything else. And that's so critical.
David Smith here with us on This Week in Money, and two big milestones actually for Apple this week. Number one, folks all lining up for the new iPad 3 and the share price clearing $600.
That just takes my breath away. Yeah. I can remember when for years Apple would go from about $12 to $60 and back to $12. And I know people that bought at $12 and sold at $18. It's got to be hurting them.
Yeah. Here's Apple now with a market value of $560 billion. Pretty hard to believe, huh?
Well, but if you compare that to some of these online services, like Yahoo and Facebook and things like that, I think that certainly most of that is probably well-deserved. They're actually producing something that you can put your hands on and touch and feel. So whether or not 600 is too high or 800 is too high, I don't know, but it's sure an interesting ride to watch.
Yeah, the new iPad is much improved over the iPad 2, a faster processor, an improved screen, and a 4G connection. Looks like a winner for the folks at Apple.
It really does, and I guess it's kind of knocked the stuffing out of the former iPad model, but that you'd expect that, But it's really getting exciting to the point that I think, it might bring in another tranche of users, and of course then that would swell their overall utilization even more. So becoming more and more a thing that the broader masses of people feel that they need to have, I guess.
And as an iPad owner, it seems that every time you turn the thing on, you got to pay Apple to do something or other, right? So it's a good business model for them.
Well, it is, and with the loyalty that they have, if they don't screw it up by having some kind of a public relations disaster like Toyota did a couple years ago or something like that, people actually, they enjoy spending their money and giving it to Apple. And as long as they could keep treating people right and be kind of straight up about things, I think the world could be their oyster. Always
fun to check out some of the rumors that are going on the markets. The latest one, Warren Buffett interested in buying a coal miner to go with his Burlington Northern Santa Fe Railroad. And the coal ETF, the KOL, is up 3% on the week. Individual miners up too. Some excitement there. But is it really true?
Well, Warren has been all over the board lately about things, and it's kind of difficult to tell. And I wonder how many more years he's going to be actively investing. But people certainly hang on his every word. And his purchase of the Burlington Northern tranche, was a tremendous move on his part. And so when he stays in his area of competency, which was those core drivers of the economy, he's really, really strong. When he branches out and starts pontificating about things like gold and things like that, he's probably a little bit less reliable to listen to, but none of us is strong in everything, that's for sure.
More with David Smith next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer averaged 182 ounces per ton. Trading symbol MOR. Website molycorp.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
David Smith here with us today on This Week in Money. It has also been a kind of a roller coaster weekday for gold and silver. Gold below 1650 again, falling to below the 200-day moving average. We shouldn't be alarmed, should we?
Well, gold and especially silver has a tendency to do this, to fake everybody out, and when they throw in the sponge, it turns right around. So I am of the opinion that gold may be a lot stronger in here than people think, but it is a little scary because you see a lot of people, pretty knowledgeable people, putting their opinions out there. But I've maintained all along, and I've been talking about this for a number of years on the show here, and that is if people should never go to a 100% cash in their metals investments unless they believe the bull market is completely over. And if you do that, you may be a hero once or twice and might sidestep a decline, but either you're not going to get back in when it's over, or the decline doesn't take place and you will be standing there with all of your cash but no position for the rest of the bull market. So if you got to be in it, if you're going to be in it, you got to be in it, or you're just not going to be.
So what's driving the weakness in gold this week?
Well, I think sentiment, something you referred to earlier. People are getting a little bit dispirited after gold had been so strong, and silver looking like they were going to break out about a month ago very powerfully. I mean, this move went from around Christmas time for like 2 months, and it was just stunning how these levels of resistance were taken out. And then all of a sudden, J.P. Morgan hit the market in 1 minute with 15,000 gold contracts sold short, and just started to cascade down and caused a lot of disheartening on the part of people. And I think a lot of people think, I guess they're so powerful that they can stop any rally there is and it'll never go anywhere.
Mm-hmm.
But if you look back over the last 11 years, we've had these shakedowns and breakdowns before, and we've always ended up over a period of time with new all-time highs, and I think we will see that. It'll take a while for the damage to get done and sort itself out, but I think we are going to see a very strong up move in the metals a little bit later this year, perhaps not too much later.
We're talking to David Smith on This Week in Money. I'd never heard of this before until reading today's Toronto Globe and Mail. The PDAC curse continues. This is interesting. Canadian gold stocks usually move up from New Year's until just before the PDAC conference in Toronto. That was last week. And then they move lower. That happened again this year. Yeah,
it seems to be. That's such a massive convention. I guess over 30,000 people attended, and everybody goes out and they buy a lot of these stocks. It seems to be the smaller ones that aren't known too well that people learn about, and they go there and they exhaust their buying power in a few market days, and then things tail off. So if a company's going to keep its price upwards, it's got to have something there to really to generate that. But also the sentiment indicator that I talked about earlier, that's making its mark felt now too, because until the sentiment really gets bullish again across the board, even if you have a good stock, it may be under pressure, even though it justifiably shouldn't be so. But then when the market turns around and they're more optimistic again, it can be off to the races.
Dave, are we still seeing the same disconnect we've been seeing all along between precious metals and precious metals equities?
We certainly seem to be seeing that, and it looked for a while like that was going to be resolved. But I'll tell you this, I think what I feel about it is you look for the seeds inside the forest. If you say, well, things haven't changed at all in the indices, well, that's true in the broad sense, but you can find a number of cases of companies that have remained quite strong and are now closing that gap a fair amount between the gold price and themselves, simply because they're so doggone profitable.
Yeah.
And these would be, I would, point people in the direction of the royalty companies, the gold royalty companies, and a couple of the silver royalty companies, because these things have been holding up very well lately. A couple of them actually making new all-time highs, and so something's going on there, which I think is the market recognizing the profitability and the predictability of these companies. And also, you're starting to see some gold companies that never offered dividends before, or that were doing it in a very limited way, are now tying them to the last quarter's performance. And I think as the bull market ages, you're going to see that to become a fairly common occurrence, whereas even a few years ago it was very, very rare, and now it's becoming more common. And to me, to see more of these companies issuing dividends or increasing their dividends, that tells me that there's an underlying strength which the indices do not reflect as you and I are looking at the charts today.
We should also talk about silver. Is the silver market behaving any differently than the gold market these days?
Well, the gold-silver ratio is still pretty wide, but from what I understand, the demand out there for the physical is very strong, and of course we know we're getting more evidence that in the case of gold, especially, and to a lesser extent silver, that China is intent on getting a pretty big chunk of what's out there, and they're doing this to the extent of buying less of our treasury notes and things like this. So I think that's going to continue. That demand is going to continue there, and the premium over spot is holding up well. So it's just a matter of people not being disheartened when they see prices go sideways or sag a little bit, because we're still at pretty lofty levels here, and I think that says something important fundamentally about the strength of the gold and silver market.
We're talking to David Smith on This Week in Money. Oil still over $100 a barrel, over a 10% increase in the last month or so. And, of course, we're feeling the pain at the pump. U.S. gas price rising above $3.80 this week.
Crude is up about $2 today, and there's just all this uncertainty going on about Iran, and nobody really knows how that's going to play out. But we do know that if we get a shooting war going there, that prices are going to be making look pretty cheap what we have now. And, of course, our economies just can't afford $200 oil to operate properly. So hopefully that won't happen. And a lot of the things you see out there that the Iranians and the Israelis and the U.S. say, a lot of that is for public consumption.
Sure.
And it's for the other side's consumption, too. So it's like smoke and mirrors, and we don't always know if these things mean anything that they're saying. And sometimes they're meant to give the other side a different type of a signal. We'll just have to see. David
Smith is our guest. He's a precious metals analyst and frequent contributor to the Morgan Report at silverinvestor.com. And don't forget, Dave is at Money Expo in Victoria, June 16th. Circle your calendar for that, and check out moneyexpo.ca if you want more details on that. Dave, as always, a pleasure. Thank you for talking to us today.
You bet, Phil. Have a great weekend.
Our thanks to our guests, Robert Campbell, Danielle Park, and David Smith. And thanks to you for listening. I'm Phil Mackesy. For AmericanManganeseInc.com, we are back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.